Taxes are one of the biggest expenses most of us face, and every year it feels like they take a bigger chunk of your paycheck. So in this video, you are going to learn 15 actionable, legal ways to pay less taxes. They're not just for the rich or the ultra-wealthy only, for which most of them are aware of these strategies and use them, but also for an employee, a business owner, or somewhere in between. There are strategies you can use to keep more of what you've worked so hard to earn. The key here is knowledge. The tax code is complex, but it's also filled with opportunities for people who know where to look. And let me tell you, most governments in the world know most people leave money on the table simply because they don't understand the system and they take advantage of this. So, let's begin. 1. Contribute to retirement accounts. One of the easiest ways to shrink your taxable income is by contributing to tax-advantaged retirement accounts like a 401k, IRA, or similar accounts like a pension contribution. The money you contribute to these accounts is tax-deferred. When you contribute pre-tax dollars to these accounts, it's like you're paying yourself instead of the IRS. For example, if you make $60,000 a year and contribute $5,000 to your 401k, you're only taxed on $55,000. Your money grows tax-deferred, meaning you don't pay taxes on gains until you withdraw it in retirement. 2. Utilize a health savings account. If you have a high-deductible health insurance plan, an HSA can save you big money. Health savings accounts are like the triple threat of tax savings. First, your contributions are tax-deductible. Second, the money grows tax-free. And third, withdrawals for qualified medical expenses are also tax-free. Think of it as a retirement account for your healthcare needs. Even if you're healthy now, you can let this account grow and use it later in life when medical costs tend to skyrocket. 3. Open a flexible spending account. Still on matters of health, FSA is another tax-advantaged account often offered by employers that allows you to set aside pre-tax dollars for healthcare or dependent care expenses. The money you put into an FSA reduces your taxable income, but remember, FSAs typically have a use it or lose it rule, so plan your contributions wisely. 4. Claim all possible deductions. This might seem obvious, but you'd be surprised how many people miss out on deductions. Deductions reduce your taxable income, which means less money owed to the taxman. Some common deductions include student loan interest, state and local taxes, mortgage interest, and charitable contributions. Even smaller ones like educator expenses, home office deductions, internet, and even part of your utility bills could qualify as deductions and can add up. The key here is to stay organized. Keep track of your receipts and expenses throughout the year to ensure you're not leaving money on the table. 5. Maximize tax credits. Tax credits are even better than deductions because they directly reduce your tax bill, dollar for dollar. For example, if you owe $1,000 in taxes but qualify for a $1,000 tax credit, your tax bill drops to zero. Some credits to look into include the child tax credit, the earned income tax credit, and credits for energy-efficient home improvements. If you're in school, don't forget about the Lifetime Learning Credit or the American Opportunity Tax Credit. 6. Take advantage of tax loss harvesting. This strategy is for investors who have stocks or assets that didn't perform well. By selling investments at a loss, you can offset the taxes on your gains from winning investments. For example, if you made $10,000 from one stock but lost $4,000 on another, you only pay taxes on the $6,000 net gain. If your losses exceed your gains, you can even use up to $3,000 of those losses to reduce your other taxable income. 7. Start a business or side hustle. Starting your own business can unlock a world of tax-saving opportunities. If you're self-employed, you can deduct a ton of expenses that wouldn't be available to regular employees. Things like office supplies, marketing costs, business insurance, and even meals with clients, within reason, are all deductible. The key here is that businesses can deduct expenses that employees can't. And if you're really clever, you might even qualify for the Qualified Business Income (QBI) deduction, which could allow you to deduct up to 20% of your business income. Starting a side hustle could be your ticket to tax savings, but remember, your business has to be legitimate. This isn't about trying to write off a vacation as a business trip. This is about creating a real business that produces real income. 8. Utilize education tax benefits. If you're pursuing higher education or paying off student loans, there are tax benefits available. The Lifetime Learning Credit can reduce your tax bill by up to $2,000 per year. Alternatively, the student loan interest deduction allows you to deduct up to $2,500 in interest paid on your student loans. These benefits are especially helpful for people working to better themselves through education. 9. Hold investments for the long term. Here's a quick tip for anyone investing. Try to hold on to your investments for at least a year before selling. Why? Because long-term capital gains are taxed at a lower rate than short-term gains, which are taxed as regular income. For example, someone in the 22% tax bracket would only pay 15% on long-term capital gains. That's a significant difference. This strategy rewards patience and helps you build wealth while paying less to the IRS. 10. Invest in municipal bonds. Municipal bonds are essentially loans you give to local governments, and the interest you earn is often tax-free at the federal level, and sometimes at the state level too. While the returns might be lower compared to other investments, the tax-free status makes them a solid option for some people. 11. Deduct business expenses. If you're a business owner, there's a whole buffet of tax deductions in the tax code you can take advantage of. From office supplies to travel expenses, many costs associated with running your business can be deducted. Even meals, entertainment, and mortgage or rent if you work from home can qualify if they're directly related to your business. Keep detailed records to back up your claims and work with a tax professional to ensure you're maximizing your deductions. 11. Invest in real estate. If you own rental properties, you're sitting on a gold mine of tax benefits. One of the biggest is depreciation, which lets you deduct the cost of the property over time, even though it's likely appreciating in value. Property owners can additionally take advantage of deductions for mortgage interest and property taxes. Depreciation allows you to deduct a portion of the property's value each year, even if it's increasing in market value. 12. Take advantage of the home sale exclusion. Still on real estate, if you've lived in your home for at least 2 out of the last 5 years, you can exclude up to $250,000 of profit, $500,000 if married, from capital gains taxes when you sell. That's right. You can pocket that money tax-free. This is one of the biggest tax breaks for homeowners, so make sure you're aware of it when the time comes to sell. 13. Make charitable contributions. Giving back not only feels good, but also lowers your tax bill. Donations to qualified charities are tax-deductible. This includes not just cash, but also items like clothes, furniture, and even stocks. To maximize your deduction, keep records of all contributions and make sure the organization provides a receipt. If you're feeling extra generous, consider setting up a donor-advised fund for more significant tax benefits. 14. Hire a good, knowledgeable tax professional. Taxes can be complicated, and the stakes are always high. Tax laws are complex and always changing, and a professional can help you navigate them to your advantage. A good tax professional can uncover deductions and credits you didn't know existed. They can also help you navigate more complex situations like self-employment, real estate investments, or running a small business. Think of it as an investment. The savings they find could easily outweigh the cost of their services. 15. Move to a tax-friendly state. State income taxes vary widely across the U.S., and in some states, you won't pay any state income tax at all. States like Florida, Texas, and Nevada are known for their zero state income tax policies. If you're flexible with where you live and work, relocating to a tax-friendly state could save you thousands of dollars a year. Paying less in taxes isn't about cutting corners or taking risks. It's about being proactive and informed. The tax code is like a game, and once you know the rules, you can play to win. By implementing even a few of these strategies, you'll keep more of your hard-earned money and put it toward the things that matter most to you.